Americans right now owe a record $1.33 trillion in credit card debt. Let that number sink in. It's a figure so large it defies everyday understanding. It's more than the entire annual economic output of most nations on Earth. Right now, as you watch this, half of all U.S. households are carrying a balance from month to month, and they are paying for that privilege at interest rates soaring above 20%, the most expensive consumer borrowing in our history. This isn't a story about frivolous spending on luxuries. This is a story about survival. The narrative that Americans are simply irresponsible with their plastic is not just wrong. It's dangerously incomplete. This is what's really happening beneath the surface of the biggest debt bubble we've ever seen. For decades, I've worked inside the machinery of fintech and traditional banking. I've seen how credit products are designed, how risk is calculated, and how real people interact with this system. I have a finance degree, an MBA, and a career's worth of experience that tells me this current situation isn't normal. It's a fundamental crack in the foundation. Today, we're going to break down the hard numbers, uncover the true causes that are forcing families to borrow just to get by, and expose the brutal math that traps millions in a cycle that feels impossible to escape. This is the new American reality. Let's start by grounding ourselves in the sheer scale of the problem, because the figures are staggering. As of the latest data, the total revolving credit card debt in the United States has hit an all-time high of $1.33 trillion. That's trillion with a T. To put that in perspective, if you stacked $1.33 trillion in $1 bills, the pile would reach over 90,000 miles into space. In just the second quarter of this year alone, Americans added another $27 billion to that mountain. We're not seeing a stabilization, we're witnessing an acceleration. This is up from $1.23 trillion in the third quarter of last year, a year-over-year increase of over 6%. But the debt total is only part of the story. The cost of carrying that debt has exploded. The average annual percentage rate, or APR, on credit card accounts is now firmly above 20%. Compare that to the pre-pandemic era, where rates hovered around 15%. We are living in the era of historically expensive money. And who is bearing this burden? It's now a mainstream phenomenon. Approximately 50% of U.S. households are carrying balances, meaning they're not paying their bill in full each month and are thus subject to those crushing interest charges. The average balance carried is over $5,000. That's not a small tab to be paying 22% on. This isn't a niche issue affecting a small group of overspenders. This is a systemic pressure squeezing the financial life out of mainstream America. So why is this happening? If it's not a nationwide outbreak of reckless luxury shopping, what is driving hundreds of billions of dollars onto credit card balances? The answer lies in the painful squeeze between prices and paychecks. For millions of Americans, the credit card has transformed from a tool of convenience into a necessary bridge to cover basic, non-discretionary expenses. We are using plastic to pay for groceries, gas, utilities, and medical bills. The primary driver is the persistent erosion of purchasing power due to inflation. While the headline inflation rate has cooled from its peak, the cumulative effect has shattered household budgets. Since 2020, the cost of food at home is up over 25%. The price of fuel and energy has been volatile but remains high. Rent and shelter costs have skyrocketed. Meanwhile, for a significant portion of the workforce, real wages, that is, wages adjusted for inflation, have been stagnant since 2021. The raises people did get were largely eaten up by higher prices, leaving them running in place or falling behind. The financial cushion that many had is gone. The trillions of dollars in excess savings accumulated during the pandemic through stimulus and reduced spending were completely depleted by 2023. That safety net has vanished. And critically, while the Federal Reserve has begun to cut its benchmark rates, that has provided zero meaningful relief for credit card users. Card rates are sticky, heavily influenced by prime rates and issuers' risk models, and they have remained at these generational highs. So you have a perfect storm: incomes that don't cover core costs, no savings left to draw from, and borrowing costs that are punitive. The card isn't funding a vacation, it's funding the weekly trip to the supermarket. When the math doesn't work and the debt piles up, the next inevitable phase is delinquency. We are now entering that wave. In the past year, a concerning 6.93% of total credit card balances have transitioned into delinquency, meaning they are at least 30 days past due. This is the highest rate in over a decade and is climbing. The pain is not distributed equally. It is hitting the most financially vulnerable the hardest. Subprime borrowers, those with credit scores below 600, are seeing delinquency rates spike far above the average. These are often individuals with thin credit files, lower incomes, and less room for error. Younger workers, particularly Gen Z and younger millennials who are newer to credit and have been slammed by high rent and entry-level wages, are struggling profoundly. The system is starting to buckle under the strain. Debt collections agencies are reporting being overwhelmed with accounts. And adding another layer of pressure, the restart of federal student loan payments in late 2023 pulled hundreds of dollars per month from the budgets of millions of graduates, forcing many to choose between their student loan bill and their credit card bill. This delinquency wave is not an abstract statistic. It is the leading edge of widespread financial distress, a canary in the coal mine, signaling that for a growing segment of the population, the numbers simply no longer add up. So where do we go from here? Understanding the problem is the first step, but the sheer scale of this debt, $1.33 trillion, poses a systemic risk that extends far beyond individual households. This isn't just a personal finance crisis, it's a macroeconomic vulnerability. When such a massive pool of consumer debt is held at rates north of 20%, it acts as a constant drain on consumer spending power. Every dollar funneled toward interest on last month's groceries is a dollar not spent in the broader economy on goods, services, or investments that drive growth. It creates a paradox. The very credit that is keeping families afloat in the short term is simultaneously suffocating their ability to contribute to economic expansion in the long term. This debt overhang threatens to create a prolonged period of stagnant or weakened consumer demand, which can ripple through every sector from retail to automotive to hospitality. Banks and credit issuers, while currently profitable from high interest income, are walking a tightrope. The rapid rise in delinquencies, particularly among subprime borrowers, signals rising credit risk. If unemployment were to tick up even moderately, a wave of defaults could trigger significant write-downs, tightening credit for everyone and potentially exacerbating an economic downturn. We are, in effect, sitting on a debt-fueled pressure cooker where the release valve, widespread wage growth that outpaces inflation, remains stubbornly shut. Given this daunting landscape, what can an individual do? While systemic change is slow, personal action is immediate and crucial. The first and most powerful rule is to break the cycle of new charges. If at all possible, the card must go in a drawer. Using cash or a debit card creates a hard budget constraint that forces spending to align with actual income. Next, attack the highest interest debt first, the avalanche method. Every extra dollar beyond the minimum should go to the card with the 22% or 24% APR, not the one at 18%. This is not just feel-good advice, it's mathematical triage, saving you thousands in future interest. For those with multiple cards and decent credit, a strategic balance transfer to a card with a 0% introductory APR can be a lifeline, creating an 18-month window to pay down principal without interest accruing. However, this is a tactical move, not a solution. It requires extreme discipline to pay it off before the rate resets and to not run up new debt on the old cards. For those in over their head, seeking a nonprofit credit counseling agency is a sign of strength, not failure. These agencies can provide legitimate budgeting help and may facilitate a debt management plan, DMP, where they negotiate with creditors to lower interest rates in exchange for a structured, single monthly payment. Yet it's critical to recognize that individual strategies have their limits. When tens of millions are facing the same structural problem, we must also demand and support systemic solutions. Policy has a role to play. There is a growing call for greater regulatory scrutiny of credit card terms, and the algorithms that drive relentless credit limit increases for consumers already showing signs of strain. Legislation to cap interest rates, while politically contentious, is being debated in some states, arguing that rates above 25 to 30% are usurious and exploitative. Strengthening the social safety net, whether through policies that directly address housing affordability, childcare costs, or medical debt, can reduce the fundamental pressure that forces people to rely on high-interest credit for basics. Furthermore, the stark math of credit card debt underscores a profound failure of financial literacy education. We teach algebra but not amortization. Integrating mandatory, practical personal finance curriculum into high schools, covering compound interest, credit scores, and budgeting, is a long-term investment in creating a generation less vulnerable to these traps. Finally, there must be a cultural shift. We must move beyond the shame and stigma of debt. The narrative that this is solely a personal failing allows the systemic issues to persist unchallenged. Open conversations about money struggles, like the one we're having now, are essential to collective problem-solving and political will. The path out of this $1.33 trillion hole will be long and arduous. It will require a combination of personal grit, financial savvy, and collective advocacy for a more equitable economic structure. The data is clear. This crisis was not born in shopping malls, but in the gap between the cost of life and the paycheck that's supposed to fund it. Beating them requires a plan more disciplined than they are relentless. Start today. Audit your statements, call your creditors to ask for a lower rate, explore every option, but also look outward. Support policies that strengthen wages and curb predatory lending. This dual approach, fortifying your own finances while working to change the landscape for everyone, is the only way to turn the tide on this record-breaking debt. The American consumer is resilient, but resilience should not be tested by a system engineered to extract wealth from their distress. It's time to build a future where credit is a tool for opportunity, not a chain of survival. Now let's break down the actual math of this debt, because it's here that the true trap is sprung. This is why credit card debt is in a category of its own, the most expensive mainstream debt by a wide margin. Let's take that average balance of $5,000 at a very real interest rate of 22%. Most people, when they can't pay the full balance, make the minimum payment, which is typically around 2% of the balance or a fixed floor like $35. If you only ever make the minimum payment on this $5,000 debt, how long does it take to pay it off? The answer is horrifying: over 15 years. And the total interest you will pay over that decade and a half? Approximately $6,850. Think about that. You borrowed $5,000 for groceries and gas, and by paying the minimum, you will ultimately pay back $11,850. You are paying for your necessities almost 2.5 times over. This is the engine of the debt trap. It's also why the Federal Reserve's well-publicized quarter-point rate cuts are virtually meaningless for the cardholder. On that $5,000 balance, a 0.25% reduction in APR might save you a grand total of $1 per month. It's a drop in a boiling ocean. The stark reality is that once a household starts carrying a significant balance at these rates, they are fighting a compounding enemy that grows faster than they can typically pay it down. Every month that passes where the full balance isn't paid, the financial hole gets deeper, not shallower. This math is what destroys budgets, crushes hope, and locks people into a cycle of perpetual catching up. So, what does this all mean? A record $1.33 trillion in credit card debt is not a sign of a consumer party. It is a glaring symptom of an economy where, for too many, wages cannot cover the fundamental cost of living. It is a sign of families making impossible choices between eating, driving to work, keeping the lights on, and going deeper into debt. And with interest rates cemented above 20%, that debt becomes a prison. Millions are now trapped in a financial cycle they cannot escape through willpower alone, because the system is engineered for them to fail under these conditions. This is the new American reality, one defined not by opportunity, but by a precarious and expensive balancing act on a mountain of high-interest debt. The solutions are complex, involving wage growth, housing policy, and financial education. But the first step is to correctly diagnose the problem. This isn't a morality tale about spending, it's a mathematical story of survival. And until the underlying pressures ease, this trillion-dollar bubble will only continue to grow.